Good morning, good morning, good morning, everybody. My name is Don Daniel, founder of Pill Method International, a better way to eliminate debt. And we're going to be talking today about how to pay off churches in 5 to 7 years without extra giving from the members. Lord have mercy. It is going to be, it's going to be a good show today. It's going to be an excellent show today. And I need you to start inviting people in right now. If you are watching us on YouTube, Facebook, Twitter, LinkedIn, whatever. Okay. If you're here listening to us on Clubhouse, please start inviting people right in right now. And if they can't come now, that's okay. What you can do is make sure that they visit our YouTube channel and subscribe, and they can watch it later. But we're going to break the numbers all the way down as to why it takes so long to pay off the mortgage on your church. If you have a church and you have a mortgage, you may be embroiled in you may be in a part of a campaign right now where you're doing pledge cards and you're doing and they're asking the families to commit over and above the regular tithe and offering to get this done. And there's nothing wrong with giving. But what I'm trying to tell you is there's a better way, an easier way, a cheaper way to pay that church off without extra giving from the members. And then you could take that money, that extra money that the members were going to, commit to that. You could put that money into ministries. How about that instead? Invest in your community. Take that extra money, invest it in community. We're going to show you how with your current mortgage budget, you can pay off a church in about 5 years. And we're just going to give you, listen, I'm going to give you some basics. Now, please, I got to give you this caveat right off the top. I am not giving you the blueprint to pay off your church in 5 years. What I'm helping you to understand is how the basics get done so that you can develop a plan based on these basics on how to get it done so that you can understand that it is possible. You want to know that it is possible and to come up with a plan. You see, when it comes to finances, ladies and gentlemen, we have been told a lot of stuff that is just not true. All right. So like right now, there are a ton of videos on YouTube right now that are, 7 minutes long, 10 minutes long, 15 minutes long, talking about how to eliminate debt, giving you 1 or 2 tips or tricks. Okay. Giving you 1 or 2 tips or tricks in 10 or 15 minutes. Listen, folks, I'm trying to tell you, if you truly want to understand how debt is structured, how the bank makes money, and how you can defeat their system, it's going to take more than 10 or 15 minutes to understand what's really going on behind the scenes. I'm just telling you. You can only get tips and tricks in 5 or 10 or 15 minutes. That's it. But a true understanding of how a loan works, you're not going to get it in that amount of time. It just doesn't happen. Listen, what you need is to have somebody break down the numbers for you. They can tell you a lot of stuff. They can tell you a lot of things going on. But let me tell you, if they don't show you the numbers, don't listen to it. It may sound good, but show me the math that makes what you're saying credible to me. Because today, ladies and gentlemen, we're going to show you the math. All right. We're going to show you the math today. And that's why it is important for you all to understand what we're talking about today, because what we have been told from financial gurus, all over the place, okay, wherever they're from, they want to give us simple things to do. And here's what it comes down to. Anything you do to get out of debt is as good as any other thing you can do. And that's not true. So I'm going to get some money. I'm going to throw it at the principal. I'm going to cut time off, and I'm going to cut interest off. Well, that part is true, but you don't know how much. Ladies and gentlemen, people have been paying off debt for years. Churches have been paid off early for years, but they have not been strategic in doing it. Therefore, they're paying way more interest than they need to pay to accomplish that fact, because they're thinking that anything that we can do to pay the debt off is as good as any other thing we can do. Not true. Not true at all. You want to maximize your interest savings. You need to learn how to read an amortization schedule. You need to know how a bank does what they do to us so that you can maximize the benefits of every single dollar that comes into the church, so that every single dollar can do the maximum amount of work that it was intended to do. And unless you understand the math behind it, listen, it's going to take some time to get this done. I've got several examples I want to show you. And I will tell you this is the first time this example has been done for the public. The first time that this particular example has been done for the general public, so that we can break this down. Now, every time we do a show, we're going to go over some of the basics, and then we add something new every time. Listen, what we don't know about mortgages will fill an ocean. These things aren't simple by any stretch of the imagination, and it takes a lot of input to know what to do and when, how much money to move, what month to move it in, what day of the month to move it on. All right. It takes that to understand what's happening. All right. So you want to be able to see what's going on. So if you're in Clubhouse here, I'm going to put the link. I'm going to put a link here so that you can see what we're doing on stage here. So let me go to, all right, and where's my link? So we're going to share that. All right, we're going to copy that. There we go. And we're going to put it in the chat. There it is. So we're copying it, putting that in the chat so that you can, if you're here on Clubhouse, either live or watching the replay or listening to the replay, you'll be able to see this link and then go to YouTube, watch the whole show. All right. And so that you can see what's going on. All right. So let's start breaking down. Let's start breaking down how the bank is taking is charging 75 to 80% more interest than they need to, even for our churches. And we're going to break that down for you. So let me go ahead and put this on the screen. All right. So we're going to change. This. We're going to put this on the screen. There we go. And there it is. All right. So here it is. First of all, let's understand. Let me get some of these ads off of here because they're distracting. There we go. And we're going to go to this one. So I got 3 examples here. All right. Now, this is Brett Whistle. I use this as a teaching tool. And then you may want to get this link yourself, Brett Whistle, and then play around with it yourself so that you can better understand what we're talking about. Okay. So I'm going to get that link and I'm going to put that in the chat. All right. We're going to put it in the chat as well. All right, let's see here. Put that in the chat. Let's see here. Go to the chat. All right, there we go. Here is the link. Copy, and we're going to put that. So, good morning, everybody. Good morning to everybody on YouTube, Facebook, Twitter, LinkedIn. Okay. And if you're in Clubhouse, make sure you go over there so that you can watch and see what we're doing. All right. So, I'm going to put this in Clubhouse as well. Paste that in there. There we are. Now, let's start to understand the basics. This is a church mortgage, $1,200,000. $1,200,000 at 6% interest for 30 years. Here it is, 6% interest for 30 years. Here's the payment, $7,194.61. Here is the first thing we need to understand about your church's mortgage. If it looks anything like this, we can get so used to making the mortgage payment, we're not looking at the total cost of borrowing. Okay? God has blessed your church to be able to make this payment and then some. All right, $7,194.61. I need to share with you what's going on behind the scenes, and then we're going to break down the numbers for you today. We're going to show you the math today so that you can understand. I need you to start sharing this. I need you to start sharing this YouTube, Facebook, Twitter, LinkedIn. I need you to start sharing this with every single person you know, whether they can come in now or later. All right. And also give us a thumbs up. All right. Give us a like on what you're seeing here. First of all, give us some likes and make sure that you comment on the video. Start inviting some folks. So 1,200,000. Here's the payment. I need to show you this. We're going to go through several years. Here is the breakdown or the summary. Here's what the bank wants in terms of interest. On a $1,200,000 mortgage at 6%, the bank wants $1,390,059.60. You know, I got to put the 60 cents in there. Listen, that's more than you borrowed. That's $1,390,000 interest. That's just the interest part on top of the $1.2 million you borrowed for a total of $2,590,059. That's why it takes so long, because it takes $2,590,000 of the church's dollars to pay off the church if we follow the bank's program. Now, I think I read somewhere that we ought to be lenders and not borrowers. We ought to be the head and not the tail. So here's what we're going to be talking about today, ladies and gentlemen, how to get this done, how we can understand how this works. So first of all, let's understand what's really going on here. That 6% really means total interest paid as a percentage of principal, 115.838%. It's not 6%. It's 115.838%. That's how that thing breaks down. Let me show you what I'm talking about. We're going to take a look at payment number one. All right. Payment number one on your church. All right. Payment number one on your church. And if you're on Clubhouse and you want to see what we're talking about, there's a link in the chat. You can go to YouTube so that you can see this. All right. And you can also come to the stage. All right. Listen. So let's go ahead and understand this payment, this breakdown of this payment. Of the first payment is $7,194.61 for this church mortgage. $1,194.61 goes to principal. $6,000 goes to interest. $6,000 interest. That's what is asked for. Listen, the bank is asking for this money in interest. They're not demanding it. It's not a requirement that you pay every single penny in interest that they're looking for. It's not required at all. This is what we call at the P.I.L.L method, interest cost. And P.I.L.L stands for prepayment of principal, isolating the principal amount, leverage, and liquidity. That's what it stands for. Prepayment of principal, isolating the principal amount, leverage, and liquidity. Let's take a look at prepayment of principal. But first, we have to understand how much we're being charged for principal. I need you to focus on cumulative principal and cumulative interest. This is the one big thing you need to know as the reason for why we pay so much interest, because we lose track of the interest. I use Brett Whistle so that we can actually see how much interest we're paying. When you get your amortization schedule from the bank, they don't have these two columns, cumulative principal and cumulative interest, because these two columns add up all the principal that you paid. See all these $1,200 payments? And it adds up all your interest payments as well. So anywhere along the line, you can know how much interest and how much principal you're paying at any stage of this mortgage. Can I show you at the end of 1 year? At the end of 1 year, the first year, this mortgage is paid down $14,736.19. That's it. That's how much money went to principal, or the money that you owe. The principal is the money that you owe. $14,736.19 went to the principal, or to pay the loan down. How much did the bank charge this church to pay this much money on their loan? $71,599.13 in interest. You tell me how fair that is. We paid down. Listen, the church is in this area to do good work. All right. And it costs and to pay it down by $14,700, the bank is charging $71,599 in interest. That's what your church is paying if this is your mortgage. If you want to figure this out for yourself, go to Brett Whistle, start plugging these numbers in. Plug the numbers in. Let me show you over the first few years what's happening. This is year one. Here's year two. $30,000 paid to principal, $142,289 paid to interest. This is year three. After 3 years, we've only paid the church mortgage off by $46,991.34, and we've already paid $212,000 in interest already. Can you imagine that? We lose track of how much interest we're paying because we're not focused where we should be focused. We're looking over here on how much we owe. We're not looking over here as to how much we pay to manage what we owe. And it is a ridiculous sum. Ridiculous sum. And guess what? You don't have to pay all of that. You never did. All right, so here's 4 years in, paid it down by $64,600. Look at there, $280,000 in interest. So in just 4 years, put my calculator on the screen. In just 4 years, this church has paid out $64,625.85 on the principal, plus the interest of $280,715.43, for a total of $345,341.28 paid out in just 4 years. But how much of that money went to pay down the church? Only $64,000. out of 345,000. Here's my question to all of you. When do you want this to stop? Put it in the chat. Put it in the comment section. When do you want this to stop? If this is your church, or even if it's the mortgage on your home, when do you want this to stop? When do you want it to stop? Because it's up to you to understand what's going on. We're going to break that down. Now, after 5 years, just 5 years in, 83,000 goes to principal, 348,000 to interest. The first 7 years, so we're saying that most of these churches can be paid off in 5 to 7 years, 5 to 7 years, if you know what to do. But if you don't know what to do, here's what happens in 7 years or 84 payments. Only $124,000 has been paid towards principal, and almost $500,000 has gone to interest in the first 7 years, $480,000. You tell me, ladies and gentlemen, if this is your church, do you believe $480,000 is too much interest to pay the bank for your church when you could be taking those funds to pay down the principal, get done sooner, and then take money and put it into the community as you intended in the first place? That's why you're there. That's why your church is in that city, in that neighborhood, in that area, to do good works, to help those that are in need. And you could do much better. You could do much better if we had the money to do that with, if we weren't paying it on interest. So let's go back. Let's go back to payment number 1. I'm going to show you some other numbers that you may not be aware of. All right. In the very first payment, let's put this down here. Let me bring my calculator back. Remember, the first payment is $7,194.61. The first interest payment is $6,000. So let's put that on the screen now. Okay. So our interest payment is $6,000. Our total payment is $7,194.61. Now, why do we look at that? What is the percentage of money that you're paying? What percentage of it goes to interest out of your mortgage payment here at 6%? Let me show you. So we're going to take that $6,000 and we're going to divide it by $7,194.61 equals 83%. 83% of your mortgage payment goes to interest in the first years. 83 cents. So let's break it down this way. Out of every dollar that you're sending to the bank to pay your mortgage, 83 cents of that dollar goes to interest, which means if 83 cents goes to interest, that means 17 cents out of every dollar actually pays off the mortgage. 17 cents out of every dollar goes to pay down the mortgage, while 83 cents out of every dollar goes to interest. Do you know, because of the math, we can flip that around? Oh, yeah. Because you need to understand what's really happening with these mortgage payments. So let's talk about prepayment of principal. We all know, and some of you are already doing it, sending extra money to your church mortgage to pay it off. But what you don't know is how much interest you're actually saving. When you pay your money, I'm just saying, when you pay your money, you ought to know what you're getting for it. And I guarantee you, your bank or mortgage company has not ever sent you a receipt saying, thank you very much for the extra payment. And because of that payment, here is how much interest you saved. You see, folks, this is why I can't do a 15 or 10-minute video on this, because it takes too much to understand it. We can't do it that way. So, because people have short attention spans, and people are putting these videos out there to get hundreds, thousands, 10,000s, millions of views so that they can get paid, because they know that you'll watch these videos if they're 7 to 10 minutes long, because our attention spans are short. Let me tell you something. When it comes to your money, a short attention span costs you a lot of money in the long run. So spend some time on our videos, which are designed to help you to understand what's really going on behind the scenes. Okay, so let's take a look at how we can optimize or maximize your interest savings. Because every time you put money on the debt, you want to put the right amount of money on your debt in the right month, on the right day of the month. Okay, so that you can maximize the amount of interest you're saving per dollar. Now, I am not going to go through optimization, because optimization takes millions of calculations to come up with the right number. That's what optimization is. It says, what's the right amount to the penny? All right, and to put on the debt. So that's how we optimize, or we leverage our money. So P.I.L.L method, P.I.L.L stands for prepayment of principal, isolating the principal amount. How much should we pay? Well, I don't know. There is no one right number for everybody. It takes a lot of math to figure that out. Okay. Leverage. When you're leveraging something, you want to pay the least amount of money at the right time, in the right month, on the right day of the month, the least amount of your money to maximize your interest savings per dollar. Not the most you can throw at the debt, the least you can throw at the debt at a certain time, so that you can maximize your interest savings per dollar. You want every dollar to work as hard as it can to eliminate interest. But right now, I'm just going to go over what happens when you do prepay to give you some idea of how much interest you can save. So I need you to look here on YouTube so that you can see this. We're going to take a look at payment number 1. Our payment is $7,000. Okay. Take a look at payment number 1. And we've made payment number 1. Let's say it's made in January. February's principal payment is $1,200.58. Let's say you prepay the $1,200.58. So you've made your regular mortgage payment in January. And now also in January, you're going to give the bank the next principal payment of $1,200.58. Let's say you give the bank that money early. Now, here's what's happening. You're choosing the timing in which to give the bank money. If you obey the timing that the bank gives you and you pay every month on time, you will pay this kind of interest every single month. Almost $6,000 worth of interest every single month. 83% of your money goes to interest, and only 17% of your money goes to pay down the mortgage. Ridiculous. Because we have not been taught how this works. At the P.I.L.L method, we're dedicated so that you can know. Watch this. So we made our payment here. We gave the bank $1,200.58 on top of our regular payment. So we're paid down to line 2 on our amortization schedule right now. Not line 1, but line 2 on our amortization schedule, because we subtracted the $1,194.61 from what we owe, plus we subtracted another $1,200.58. Here's what's happening. On this first one, to give the bank $1,194.61, it cost us $6,000 in interest. But when we gave the bank $1,200.58 in the same month, all of this money went to principal. None of it went to interest. And so we're paid down to line 2 in the same month. Our next mortgage payment is on line 3. There it is. Okay, what happened to line 2? Line 2 got eliminated not for $7,000, but for only $1,200. And it saved us $5,994.03 in interest this church never has to pay. What? Almost $6,000 in interest. In other words, it costs to give the bank $1,194, it costs $6,000. To give the bank this $1,200 costs $0. $0. Not a little bit. $0 it costs to give the bank this $1,200 because we're paid down to here for no additional cost. And that's how it works. So Don, I find that hard to believe. I find it hard to believe. Can you show me the math on that? Okay. Can you show me the math? Let me show you the math on this. Folks, you need to see this. We're going to break down what the bank is doing to churches, to individuals, to businesses. And I'm going to show you how they make their money through interest here. Okay. So the cost, the interest is 6%. That's the interest rate. That's the interest rate. But here's how the bank does it. Okay. They have your interest is 6%, 0.06. They take the 0.06 and divide it by 12. So we're going to divide that number by 12. That equals 0.005. This is the number the bank uses every single month on your mortgage, 0.005. They take that number and they multiply it by your total balance. So the very first balance is $1,200,000. So we're going to multiply it by $1,200,000. Okay, 1, 2, 3, 1, 2, 3. All right, 1,200,000, and it comes to $6,000. You see, that's the very first interest payment. That's what they're doing. So every time they see a balance, they have to charge you 0.005% or 1/12 of the interest rate times your balance to come up with the new interest cost that month. So if you pay your bank this first payment and give them the second principal payment, then the bank's computer doesn't see the first balance here. It sees the second balance at the end of the month, $1,197,604.81. So it has to calculate based on this number. So let's put the magic number, the multiplier, 0.005. That's 1/12 of the interest rate. And we're going to multiply it by this new balance of $1,197,604.81 because we paid the principal on line 2 early. So we're going to multiply here. 1,197,604.81. There we go. Equals, oh man. Sorry, I didn't clear it out. Sorry. 0.005 times 1,197,604, $604.81 equals. All right, 5,998.02. There it is. 5,998.02. So we skip by this 5,994.03 that we never have to pay. How about that? Isn't that amazing? All right. So now, what would happen? What would happen if we gave the bank the next three principal payments? Okay. 1200, 1206, and 1212.62. It would eliminate these three interest payments, almost $18,000 in interest. And we were giving the bank an extra, what, $3,600? An extra $3,600, but it saves us nearly $18,000 in interest if we do that. Do you see what's happening with this church? They can save a ton of interest if we just know how. All right. Now, let me give you, since we've broken it down this far, I'm going to give you a little bit more information on how this is just, listen, there are many ways to get this done, many ways. And I need to give you this caveat again. I repeat, I am not giving you a blueprint for your church when I do this next example. What I am giving you is an idea of how it can get done and how you can save a lot of interest without extra giving from the members. Okay? Now, again, I am not telling you this is what you need to do. What I am telling you is it is possible if you understand the basic principles of prepayment of principal, isolating the principal amount, leverage, and liquidity, if you understand that. So let's just say your church is doing very well with the tithe and offering, okay? And they're blessed to be able to pay this mortgage easily. And they have some money in reserve, okay? That money in reserve is actually sitting in the bank. And if it's sitting in a savings account, it's probably banking what? 0.1%, not less than 1% interest. Okay. Not making very much interest at all. Whatever it is, it's not very much. Okay. So let's just say that this particular church has, I don't know, at least 50 to 100,000 in reserve. Okay. Let's say we have 50,000 in reserve. Now our program takes into account your income and your expenses, and then comes up with the right number to prepay in the right month. So without that information, I'm just giving you some numbers so that you can understand how this works. So let's just say that in this first year, because of this, I need you to understand this. If we could prepay one of these payments and eliminate one line of interest and one line off your mortgage, if we can prepay three principal payments and eliminate three interest payments, and our next mortgage payment is on line 5 of the schedule, that's our new February payment. Look at line 12. We're paying $14,736.19 towards principal, but it costs $71,599 in interest to do it. What if out of our $50,000, we took out a little less than $15,000? Okay. Now remember, there are certain things that you have to know when you're doing this. Let's just say that this particular church, all right, can, after the tithe and offering come in for the month and all the bills are paid, all right, let's just say that they can average putting $3,000 a month into the reserve fund. They can put $3,000 a month into the reserve fund. Whatever it is, they know what goes in there. That's the point I'm trying to make. Okay. And I'm using round numbers just to make it easy, because I've never really been a math person, but I like to make it easy so that people can understand what's happening. So $3,000 a month goes into the reserve fund. So we're going to take out a little less than $15,000. In this case, $14,736.19. That's how much we would pay in the first year. So here's my question to you. Do we have to pay this $14,736.19 in 12 monthly installments? If I have any pastors on the line, I need you to answer this. I need you to focus in here right now. Do we have to pay this $14,736.19 in 12 monthly installments? Or could we, since we have about 50,000 in reserve, could we take 14,736.19 out of the reserve and apply it to principal in the first month? Could we do that? I'm telling you, it is, listen, it is your right to do it. It's actually written into the contract on your mortgage. It is your right to be able to do this. I'm just showing you what happens when you do. Because right now they're taking your extra payments. You're just not knowing what you're getting for it. All right. That is I'm talking to the pastors. I'm talking to the finance committee of the church. I'm talking to whoever is in charge of the finances. You know that you're trying to pay the church off early, but you have no idea how much interest you're saving. I'm giving you an idea right now. So if we take this $14,000 from the reserve fund, can we apply it to the mortgage in month one? The answer is yes. So let's bring back our calculator. Now remember, make people prove it. I have $1,200,000. Okay, $1,200,000, and we're going to subtract $14,736.19 worth of principal in 1 month, not over 12 months. Let's subtract 14,736.19 equals 1,185,263.81. That's exactly what we have here. 1,185,263.81. So you can literally, excuse me, you can literally be there in 1 month. Pastors, finance people who are on the finance committee of your church, listen, I need you all to be listening to this and to share it with everybody. What would happen if we did this? What happens to all the interest payments between line 2 and line 12? You just saved over $65,000 in interest that the church doesn't have to pay your loan down to right here in 1 month instead of 12 months. And your next mortgage payment for the next month is actually on line 13 of your schedule. Pastors, are you seeing that? Committee members, are you seeing that? Church members, are you seeing this? It didn't come from, the money didn't come from extra giving it comes out of the natural giving pattern of the church. The natural giving pattern that naturally has money after all the bills are paid, including the mortgage, has money left over so that they could put it into the reserve fund. So now, here is what may be going through somebody's mind. We can't keep tapping into the reserve fund because if we do, we won't have a reserve fund. And you're so right. So if, for instance, if $3,000 is going into the reserve fund, and let's just say the church says, listen, we put about $15,000 on the mortgage, knocked off a year, saved over $65,000 in interest. Let's just say we don't do anything until we put the $15,000 back. What if we did that? Okay. How long would it take at $3,000 a month putting into the reserve fund? How long would it take to put that money back? You're exactly right. It would take 5 months. So for 5 months, we need to pay we're going to pay the minimum payment on the mortgage for 5 whole months. So if we give the bank this and we're paid down to here, all right, we're paid down to $185,263.81. That's how much we owe now. And that's what the bank is going to calculate on. But let me tell you this part. When your loan is amortized, When you pay down to right here, this is a whole new mortgage. Yeah, it is not one mortgage for $1.2 million. Every time you make a payment, it changes your amortization schedule and you have to have a new one. So it's a brand new payment every month and a brand new mortgage every month because now you paid interest on the 1.2 million. Now you're going to pay interest on 1,198,805. And then the next month you pay interest on 1,190. So each time you do this, it's a brand new mortgage. So it's not one mortgage, ladies and gentlemen, it's 360 separate ones. That's why it is so expensive. That's why we need to pay attention to interest cost, not just the interest rate, but the interest cost. You see, everybody's trying to get the lowest interest rate, and they're focused on that. And they think once they got the lowest interest rate, all their work is done. Let me tell you something. If you can afford this payment, the higher interest rates are better in paying off mortgages cheaper and faster than the lowest interest rate you can get. Whoo! How about that? Okay. Now watch this. Watch this. We're going to take this number here because this is our new number. We're paid down to here. All right. And so when we take this number and put it into our calculator, okay, remember our magic number is 0.005. This is our new balance, 185,263.81. So we're going to multiply it by 1,185,263.81 equals 5,926.32. We got to round that one up to a 2. There it is, right here. So this is where we start our next mortgage if we put all of that on down once. So here's what it would look like. Here, here's my new example. I know we now owe 1,178,885.62 after, watch this, after 5 payments. So remember, we're not going to make any more prepayments until we put that $15,000 back into the reserve fund. So we're going to pay payment number 13. That's 1, 2, 3, 4, 5. We're paid down to right here. 1,178,852.62. That's where we hit the mortgage again. With another $15,000. So 1,178,852.62. So let's put this in here. This is where we are now. We only have 343 payments left because we put $15,000 on the mortgage. See how that works? We're using the same payment, the same interest rate, but a new balance. Okay. And if we leave the number of payments blank, it will tell us we now have 343 payments left. So let's scroll down. And now we're able to put another about $15,000 on because we put that money back. What would happen? So if we did that, it'll take us down to about here, 14,666.51. Okay. And we're paid down to here. And it saves us another $60,000 in interest. We just got saved again. All right. So we made a payment. Then we put our about $15,000 on, and now we paid 5 payments in a row, and then we paid another payment on another prepayment of about $15,000, and it brings us down to here, right? And now for the next 5 months, we have to make regular mortgage payments so that we could put that $15,000 back into the bank account. Okay, so that's 1 payment, 2, 3, 45. So we're paid down to here. 1,157,254.83. We're paid down to right here. So if we take a look at this, 1,157,000. Look, there it is. 1,157,254.83. We're paid down to here. And now we're going to do it one more time. We're going to give the bank 15,884.86. All right. Make 5 more payments. 1, 2, 3, 4, 5. Okay. So we can put the $15,000 back, and we're down to 1,133,856.41. This is where we are now. That's the new mortgage. All right. Now I've got my notes here. How many months did it take us to get down to there? So in the first one, okay, on the first one, we paid this. All right. We paid our mortgage, and then we gave the bank this. All right. We paid it all at once, and then we put 1, 2, 3, 4, 5. That's 6 months in total. 6 months in total. And then we did it again, another 6 months, and then we did it again, another 6 months. So we're paid down to here. That is 18 months. We're paid down to 1,133,856.41. It took us 18 months. Now, when we add up all the interest payments, all right, that we paid, okay, in the first month, okay, the first time we did it, we paid $6,000 in interest. Then we paid what? Five. Let's see. In the next 5, 1, 2, 3, 4, 5. All right. So the next 5. So we paid about $30,000, $35,000 in interest the first time around to get down to one. Let's see. Let's see where we paid down to here. All right. 1, 2, 3, 4, 5. There we go. So that's a total of 6 months. Total of 6 months. All right. About $30,000 in interest. The next one, we did it again. We paid $29,035.77 to get paid down to this line. Okay. And then to get paid down to this line, we paid another $28,459.49 for a total to pay it down to here. We paid a total of $93,063.12. $93,063.12. That's still a lot of money to pay it down to here. All right. But let me show you something. If we had made every single payment on time to pay it down to this exact number, let me show you what the bank is doing to us. It wouldn't cost us $93,000 to pay it down to here. Okay. Here's what it would cost us. Okay. This is the original mortgage. All right. To pay it down to, let me look at it again, 1,133,856. Okay, 1,133,856. That's where we would be. Look here. It would take 49 months to pay it down to here, not 18. It would take 49 months to pay it down to here, not 18. We've paid $66,000 towards principal, but it would cost us $286,392.30 to get it down to here instead of $93,000. Let's see how much interest we've saved already in 18 months. So the bank wanted $286,392.30 from us, from the church, in 49 months. To pay it down to the same place where we owe $1,133,000 using an accelerated method, taking money from the reserve fund, then putting the money back into the reserve fund, and then using that reserve fund again for this purpose. We're not asking the church for extra money. We're just using the normal giving patterns of the church to take that money from the reserve fund and put it on the debt. Look what happens. Look what happens when you do. So it cost us $93,000 to get it down to the same place where we're paying 60 some thousand dollars on the debt. So listen, let's see, 133 to get it down to here. It cost us $93,000. So let's bring up our calculator again. Let's subtract 93,000, $63.12. That's how much interest it cost. Already, we've saved $193,329.81 to pay it down to the exact same place in 18 months instead of 48 months. And we didn't ask the church members for an extra dime to do it. If you're understanding what I'm talking about, put a number 9 in the chat right now. Put a number 9 in the chat or comments right now if you're understanding what I'm talking about. If we paid it down to the exact same spot, it takes in 18 months paying $93,000 in interest instead of what it would cost normally to pay it down to here, $286,000, and it would take 49 months to do it. We took 4 years, 1 month, and compressed it into 18 months. If you're understanding this, put a number 9 in the chat. If you don't understand it, put a number 1. Put a number 9 if you get it. Put a number 1 if you don't. Karen Anderson asks, hi there, does this work in the UK? We already have clients in the UK, Karen. Yes, it does. It works very well there. Okay? It works very well in the UK. All right. Any other questions? Any other comments about this? Put a number 9 if you get it, if you like it. Put a number 5 if you don't understand it. Okay? All righty. So do you get where we're going here, ladies and gentlemen? Do you get where we're going here so that you can understand? This is why we can't do this in 5 or 10 or 15 minutes. It's a lot of math to do this. Now, let's just say we want to optimize and figure out how much interest we're saving each and every time. We want to save the most in interest. So let me give you an idea of what has to happen there. All right. In this very first example, if we are prepaying this and saving a ton of interest here, we can figure out how much interest we're saving per dollar. We can figure that out. So let's put that into our calculator. Okay, 71,599.13 divided by what we prepaid. Okay, 14,736.19 equals $4.80. We got to round that 5 up to a 6 because this is an 8. $4.86 per dollar. Okay, $4.86 per dollar. That may or may not be the optimized way to do this. What if we did it a different way with a different amount from the church budget, where we could save a whole $5 for every dollar, and that was optimum. To maximize your interest savings means this. Find out that number that you can pay towards this mortgage to save the maximum amount of interest per dollar. And you have to figure that out to the penny. Because what I'm telling you is, once you find that out, putting any more money on, the amount of interest you save per dollar starts to go down. If $5 is the maximum you can get per dollar, putting any more money on, your amount of interest you can save per dollar goes back the other way. Because maximum means maximum. You can't get more than the maximum. What you don't want to do is violate the law of diminished return. That's why with the P.I.L.L method, you're going to find the least amount of money, not the most, the least amount of money out of your storehouse that you can put on the debt to maximize your interest savings per dollar. This is why most people never really get to maximize their debt, because they've been told or led to believe that anything we put on the debt is as good as any other thing you can put on the debt. All right. Let me show you. Let me give you an example. So we have $4. If we prepay the 14,000, our interest savings is $4.86. I'm putting that in my notes. $4.86. Let's just say the church decided, you know what? Let's put 46,000 all at one time and knock off 3 years. And this is our savings. Okay. We're going to knock off 3 years all at one time. All right. Let's see what that does. So we're going to take our calculator, put in 212,000. Okay. 0.14. Now you guys can do this on your own. I put the links in the chat for Brett Whistle. You can play around with this thing. I'm telling you, it's amazing. 0.62. And we're going to divide it by 46,991.34 that we could prepay and knock off 3 years worth off the mortgage and save 212,000 all at one time. So we're going to divide it by 46,991.34 equals $4.51 per dollar. Ladies and gentlemen, church treasurers, pastor, finance committees, it's not just any old amount. You want to optimize this if you can. Our program optimizes it. Now, I'm giving you the basics for free. If you want to just take the basics, that's fine with me. At least you're saving a lot of money in interest, paying off that church in record time, and you're not asking the members for a single extra dime because you already have it in reserve. I'm giving you the basics. All right. If you want a consultation, we can take care of that too. But if you want our full program, this is how the full program does all of the math and guides you like financial GPS, so that you can save the maximum amount of interest that's mathematically possible. And I'm telling you, it will save you at least on like a mortgage like this, at least $50,000 to $70,000 more in interest to optimize your savings than to do this and guess on how much money you want to put on the debt each time. That's a lot of money. That's a lot of extra interest that's saved. And what could you do with $50,000 to $70,000? What could you do with, say, the bank? Listen, this is ridiculous how much the bank wants. Let me go back up to the summary. $1,390,000. $1,390,000. What if we could? I lost my calculator. Where did it go? It went down. There it is. I got to bring it back. There we go. We've got, let me see here. Let me give you an idea. 1,300,000. $90,000. Okay. And let's just say we can get that down to, I don't know, $370,000, $350,000 in interest instead, in total, instead of $1,390,000. That is a significant savings, and because of that, because you can pay so little interest, that means more of your money is going to principal faster because you're choosing the timing that the money goes to the bank. Do I have any questions from anybody online? You can write it, put it in the chat, put it in the comment section, or any questions from Clubhouse here. You can type it in the chat, or you can raise your hand and come to the stage and ask it outright. Raise your hand, come to the stage, and we'll talk about it. Do I have any questions? Because if I don't have any questions, then I feel my job is done for today. Because we're getting ready to do our year-end show on the 31st of December, where I'm going to go over the history of the amortized mortgage, where it came from and who it benefits, and how we got stuck with a program that cost us so much money, and the banks are making trillions. Now, am I anti-bank? No, I am not anti-bank. Why? Because they provide a valuable service. What I'm saying is we haven't been taught how to use the system correctly so it saves us money. All right, that's why the P.I.L.L method is in existence. Prepayment of principal, isolating the principal amount, leverage, and liquidity. Understand that, and understand that you can get technology, fintech, financial technology that is designed to make sure you save the maximum amount of interest that's mathematically possible for you, because we're going to take a look at all the different ways that you can spend your money. You see, it takes a lot of math because computers are not smart, ladies and gentlemen. They're just fast. And how does a computer figure out how much money to put on the debt? It takes a look at what you have. It takes a look at how much money you're going to be bringing in the future. All right. And then it looks at how much money that it suspects that you'll have at a particular time. And then it takes 1 penny of that money and moves it on every day of every month and figures your interest cost. Then 2 pennies, then 3 pennies, then 4 pennies. It does it so fast, it boggles the mind, till it comes up with the right amount. And just say it's $15,326.75 for your particular church. Do you know how long it would take you to do that by hand to come up with the optimum number to put on the debt to kill the maximum amount of interest per dollar? It would take forever, where a computer can do it in 2 or 3 seconds or less. A fraction of a second, it does all those calculations. This is called permutations, okay? It does all those permutations so that you can figure out what is the optimized amount to kill the maximum amount of interest. It takes all of those calculations, millions of calculations, and then it has to do it the next month, and then the next month, and then the next month, until it gets to the point where, ladies and gentlemen, guess what? If you have a system that tells you how much interest you could save per dollar, then you will know it's going to get to a point where it doesn't make sense to prepay anymore because you have to pay so much money to save so little interest. Let me give you an example. Let's scroll down here towards the end of this mortgage. I want to show you something. Do you see where you would have to prepay $5,700 here to save $1,400 in interest? And you see how fast it starts to go down, where you would have to prepay a whole $6,000 whole $6,194.79 just to save $1,000. At a certain point, folks, it doesn't make sense. If you have another place to put that extra money so that it can do more for your church, some churches have investments. Yeah. So you can invest in some property around the church and to expand the ministries. So if you take that money and put it into property or into other investments, then you can make more money by leveraging. You can make more money than you can save in interest at a certain point along the way. Instead of just continuing on to pay the church off to zero. There's a certain point where, it just makes sense just to go ahead in the last year or so, just make the minimum payments. Because the reason why you pay your church off early is not for the fact that we look forward to the mortgage burning. The reason why you pay your church off early is to save interest, period. Because if all of your loans, whether personal, whether it's church related, whether it's business, if all of your loans were 0% interest, is there any financial benefit to paying the loan off early if it was 0% interest? And the answer is no. So if that's what's going on, then why does every other program out there only focus on how much you owe, what your payment is, and what the interest rate is, when we should be focusing on the real culprit, managing interest cost? Lower the interest cost to its mathematical minimum for you, for your church, for your business. And you can't do any more than that will save you the maximum amount of money in interest. You can't save more than the maximum, ladies and gentlemen. You can only save the maximum. Any more money is a waste of money. Do you get what I'm saying? That's violating the law of diminished return. You don't want to put so much on that your return starts to work against you. I want to get a maximum return every time I put money on the debt. And when it stops becoming a maximum return, then I need to do something else with the money. That's why not only do we offer technology, but we offer coaching so that we can be there. The P.I.L.L method can be there for your church, for your business, for you personally. We'll be there for you to help you to understand through coaching how to maximize the use of every dollar. It's going to be, listen, it's a great thing to be able to do this. I hope that this has been beneficial to you. I hope that you like what you heard today. All right. And if you have, put a fire emoji in the chat, put some hearts in there. Let us know that you appreciate this information that you received today. And if you want to know more about how to get a hold of the P.I.L.L method, you have, let me put it in. Let me go ahead and change things around here. All right. And we're going to put this here, take this out. There we go. All right. So we're going to go over, I'm going to, let me see here. I got to put some banners in here. All right. Let me put the banners in. And there you go. You want to know more about, go to ice10k.com, ice10k.com. If you want to know the month, day, and year your church could be debt-free, but also know how much interest you could save, the maximum amount of interest you could save, you want to work with us. You want to work with us so that we could save you the maximum amount of interest so you could put that money somewhere else. Sharon N. Jones gives us 2 fire emojis. Thank you, Sharon. We appreciate you. All right. So, and so go to ice10k.com and get a savings report. You can also find our business number in there, but so you don't have to work for it. And if you're in Clubhouse, it's at the top of the page. So if you don't want to work for it, let me give you a business number. It's 256 here in Huntsville, Alabama, 886 Boom. 1867. You may want to ask some questions about all of this. You may be a pastor. You may be a church treasurer. You may be a member of the church, and you want more information on how you can have the P.I.L.L method come to your church or organization to save money. Let me put that number in Clubhouse as well. 256 886 1867. There you go. All right. So now you guys have it. So everybody has it. They got the number to ask more questions if you want to ask some questions even before you fill out the to get a savings and earnings report. It's a little different for a church than it would be for a person who has a residential mortgage. Okay. So also, let's go ahead and I'm going to put on the screen. We're going to put the screen the ice10k.com. That's my digital business card. Okay. We're going to put that back on the screen. Okay. There we go. There it is. And we're going to share that with you. Okay. There we are. So we got ice10k.com, and we have Dr. Eric Thomas here who talks about paying off his mortgage, and you can become an affiliate and help us to get the message out. We need your help getting this message out. So when you fill this out to become an affiliate, all right, the P.I.L.L method, you put in your name, your phone number, your email, put in how you want to get paid, and then click submit, and then we'll pay you through however you want to get paid. And you can make anywhere from $300 to $3,000 a month being an affiliate for the P.I.L.L method without selling anything. We need more people to watch our YouTube channel. When you fill this out, know that you will not get an immediate response. It's going to take about a week to get an email from us giving you some basic instructions on what to do. Okay. So that's what we're doing there. Also, let's go back and get my book. All right. Get the book today. All right. P.I.L.L method, the P.I.L.L method, a better way to eliminate debt. It's on Amazon, and you can click that link and get the book today. All right. Let's get the book. And that will help you to understand what's going on. Church treasurers, finance committee members, pastors, whoever's involved, even church members. If you want to know more about how all of this works, this is the only book out of 33 million titles that breaks down the amortization schedule like we did today. All right. Well, not exactly like we did today. It gives you some basic concepts. We went a little deeper today. All right. So make sure you get the book and watch and rewatch this video and share it out with other people and ask them to subscribe to our P.I.L.L method YouTube channel, like the videos, and also, comment on the videos. All right. So there's a lot to learn. So don't forget, we'll be back here Friday with more information. But on Sunday, it's the last day of the year. We're going to dive deep, and I mean deep, into why we pay loans the way we do here in the United States, and the whole world has followed after. Okay. Why we pay debts the way we do, and who's making money, and who's part of this whole thing that supports making trillions of dollars for bankers and investors. And we're thinking the whole system was put in place for us. I'm going to show you how our education has been left out of the whole mix. I'm going to go from beginning to where we are now and why the system is the way it is. And I'm also going to tell you, you don't have to do it that way. You can pay off all of your debt, the mortgage, student loans, credit cards, car loans, everything in an average of 7 to 9 years. Churches can be done in an average of 5 to 7 years without extra giving from the members. And if you're an individual, you don't have to sacrifice lifestyle to do this either. It is a good thing. Okay, ladies and gentlemen, we're going to be out of here. We're going to get our last word. We're going to get our last word from Eric Thomas here. So let's take this off the screen. Our last word from Eric Thomas, and then we're going to, do our outro, and then that's going to be it for today. I want to thank you for being here. I hope this has been beneficial to you, and share it with your church family and everybody who has anything to do with finances in your church. Make sure they watch this video. All right. I want to thank everybody for being here, and we'll see you on Friday at 7 a.m. Central Time. That's 8 a.m. Eastern Time. And let me go ahead and get that video ready. Before I forget, starting in the new year, we're going to a brand new format for online. Everybody who's watching us online, on YouTube, Twitter, Facebook, and LinkedIn, we're going to change things up a little bit. How would you like to be able to talk to us live online? We're going to fix it up and make it a call-in show so that we can not just hear me talk, but for everybody who comes online here on YouTube, we're going to send you out a link where you'll be able to come online on your camera, on your computer, on your phone, on your iPad, on your laptop, whatever it is. You'll be able to join us live right here online, starting our first show in January. It's going to be a whole new format. We love taking your questions, and listen, we're going to take your questions live, and then I'll answer, and we'll answer the questions and we'll show examples on how we're answering those questions. So bring your financial questions. All right, start preparing now. Bring your financial questions, because we're going to a live format. You don't have to type your questions anymore. You can come to our broadcast and be live with us here on YouTube. All right, ladies and gentlemen, thank you so very much. We'll see you on Friday. Eric Thomas, what do you have to say to us?
Listen to me, y'all. Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, "Oh, you blew up, but how long is you gonna keep making this kind of money?" I was like, "I don't know, forever." She's like, "You sure?" Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, "You ain't gotta do that, you can do this." But when I paid the house off using that program, it took the stress level all the way down from my wife, because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.